Hello everyone, welcome to Global Economy and Foreign Exchange Market Outlook for the second half of 2023. I'm HYUN from Shinhan Bank Solution and Training Center. Thanks for joining us today. During the first half of 2023, the foreign exchange market has taken a roller coaster ride as the Fed maintained a tightening stance due to sticky prices and the US banking crisis and default crisis emerged. Today, we'll go over some issues related to the foreign exchange market and finish up with forecasts of major and emerging market currencies in the second half. The global economy in the second half of 2023 will follow a U-shaped path due to the pressure to reduce the accumulated debt and the aftermath of the sudden monetary tightening. So the global economic growth this year will be remained at a relatively low rate of 2%. Of course, China, which has abolished the zero-COVID policy, will perform somewhat better in terms of growth. But it'll take more time for developed countries to escape from the pressure of rising inflation and interest rate hikes. As a result, even if we can avoid extreme recession or serious systemic risk, we cannot be free from the risk of low growth, credit uncertainty, and financial market volatility. The first issue to be looked at is the contraction of the U.S. commercial real estate market and the crisis of regional banks, which are gradually coming to the surface in the wake of the SVB bankruptcy. So far this year, 3 U.S. commercial banks have gone bankrupt, with assets of about $55 billion. Commercial real estate is being seen as the next epicenter of risk. In particular, the cooling of the office market is becoming more pronounced due to the fourth industrial revolution and the COVID-19. The current vacancy rate for U.S. offices is 19%, which is the same level as in the late 1980s during the S&L crisis. As a result, loans are becoming more conservative and it's becoming more difficult to raise funds. If we look back at the S&L crisis and the global financial crisis, the risk of bank bankruptcy was inversely proportional to the size of assets and proportional to commercial real estate loans. In other words, the commercial real estate market had a very significant impact on distinguishing between the living and the dead. Therefore, we need to pay close attention to the credit risk of small and medium-sized regional banks in the U.S. and the impact of the contraction of the U.S. commercial real estate market on the global financial market for quite some time. Second is recession, the Fed, and the direction of the U.S. dollar. The U.S. economy will not fall into a severe recession like in 2008. But it'll have to endure low growth, even if it may be shallow, due to the aftermath of monetary tightening as excess household savings are gradually exhausted. In the future, the Fed will find it difficult to focus only on inflation due to the anxiety of regional banks. Of course, the Fed will not easily let go of its concern about inflation, but it's expected to gradually change its monetary policy while taking into account the economy and financial market stability. As a result, the Fed's rate hike will be completed at 5.5%, and the expectation for a pivot will gradually grow in the fourth quarter. And the Fed will lower interest rates in the first quarter of next year in an effort to balance monetary policy. Of course, there's a gap between the actual speed of the pivot and the market expectation. But considering the fact that the US dollar has been weak for more than 1 to 2 years after the end of the rate hike, in the medium to long term, we need to keep in mind the weak dollar movement. Third, I'd like to talk about the global semiconductor market reorganization led by the US. We need to look back at the US shale revolution, which was strategically launched to check the weaponization of resources and revitalize domestic manufacturing. In 2015, OPEC responded by increasing production, but based on advanced technology, the US took the lead in shale and became the world's largest oil producer. In the end, the entry of the US, which is the largest consuming market, to oil production showed that it could trigger global competition, market restructuring, and price control. Therefore, the restructuring of the semiconductor ecosystem led by the US to isolate China will cause damage to the global supply chain. In addition, the US, which is already at the forefront of the semiconductor field, is highly likely to acquire production and price control capabilities centered on system semiconductors. We also need to consider the risk of supply chain disruption, which has been strong due to the US-China conflict and technology regulations. Lastly, let's talk about de-dollarization. Recently, de-dollarization movements have emerged, especially among emerging markets such as China and Russia, using their own currencies for trade settlements. However, the status of the US dollar will not be significantly shaken for a while. The global capital market has already surpassed the real economy due to global liquidity release and financial innovation. And naturally, the preference for the US dollar, which has completed the convenience of trading and financing in the financial market, will not change easily. But if we look back at the example of the British pound, which lost its position as a leading currency to the US dollar due to high inflation and massive government debt after World War II, we need to be more careful about internal risk related to the US fiscal situation than external factors. In 10 to 20 years, the US government debt, which is approaching 200% of its GDP, will gradually lower the trust of US treasuries and the dollar. Now let's take a look at some implications for the foreign exchange market. First is credit risk, which is a result of high debt and high interest rates. If we consider the abundant liquidity and the pivot of the central bank, it'll not spread to an extreme systemic crisis. But we'll have to endure high interest rates for a long time. Credit risk can emerge at any time, since in developed countries, governments are under pressure to deleverage, and in emerging countries, households and businesses are under pressure to deleverage. As a result, exchange rate volatility will periodically increase in the area where recession and debt burden overlap. The next variable is global political and geopolitical risk. As we've seen in the Ukraine crisis and the semiconductor alliance, the political and geopolitical environment could become unstable as the interests of the US, Europe, and China are sharply confronted. Also, as nearing the year end, the US presidential election season will begin with the selection of presidential candidates. And Taiwan will also hold a general election in January next year. So uncertainty related to the Asia region will increase. While in the past, whenever global geopolitical risks have occurred, there has been a tendency for capital outflow from emerging markets and inflow to developed countries. So as tension in Asia grows, the instability of exchange rate could increase due to the outflow of foreign investment capital. Third, let's look at the differentiation of monetary policy. As the global monetary policy is at a turning point, it's expected that there will be a ripple effect due to the interest rate gap. In developed countries, the ECB's rate hike could continue a little longer than the Fed, and the BOJ could also give up negative interest rates in line with inflationary pressure. The US stock market, which entered a bullish market in early June, and the strong monthly employment, seems to be mismatched with concerns about recession. However, the stock market rally is concentrated only on some large cap stocks due to the AI craze, and the monthly employment is a strong lagging indicator of the economy. So we need to be cautious about the potential for economic entities and market psychology to become conservative due to the full-scale penetration of the effects of tightening into the real economy and the erosion of trust in the financial sector. The Fed's rate hike cycle is nearing its end, and major economies such as Germany and China are also improving from the worst conditions of the previous year. Higher interest rates could be a game changer for global financial risk, but unless it goes extreme, the dollar is expected to be stable. The dollar reversed its excessive rise in the previous year at the beginning of this year and maintained its strength in the first half, but its momentum is expected to weaken in the second half. The expected range of dollar index is from 99 to 106. In the second half, the euro is expected to rebound after further reversing the upward trend in the first half of the year. Despite the acquisition of Credit Suisse in March and high AT1 yield, the soundness of the European banking sector, which was weak in the past, has improved. And in terms of monetary policy, there's a consensus that the ECB still has more work to do than the Fed, but it's not enough to drive the rise of the euro. Also, as the energy crisis, which led the rise of the euro until April, has been averted and the benefits of the economic recovery in China have been exhausted, the euro is likely to receive downward pressure. The euro to dollar rate is forecast to be at the level of 1.04 to 1.11. In March, the distortion in the Japanese bond market was largely alleviated as the U.S. regional bank turmoil and the change of leadership in the BOJ occurred. This has led to a decrease in the urgency of policy change. But there's a consensus that Japan is emerging from deflation and the BOJ is still likely to seek policy change, mindful of the side effects of ultra-easy monetary policy. The adjustment of the dovish policy in the second half of the year is uncertain. But the market will be adjusting the pace of yen weakness in anticipation of such possibility. The slowdown of the U.S. economy is also expected to defend the lower end of the yen. The dollar to yen rate is forecast to be at the level of 128 to 145. Since the reopening of the Chinese economy, the domestic market has been recovering, while exports, imports, and manufacturing vitality are still far from a full recovery. The Chinese economic recovery seems disappointing, and foreign investors, who seem to be returning to the Chinese mainland stock market at the beginning of the year, are becoming more cautious about investing in China. The poor performance of Chinese indicators will be accompanied by a response from the Chinese authorities. It'll not be comprehensive, but it'll pursue the red line, and it may improve market sentiment. Even if Chinese authorities' response falls short of market expectations, it's expected that the depreciation pressure on the yuan will gradually ease as the market-friendly response calms the market. The dollar to yuan rate is forecast to be at the level of 6.8 to 7.3. The dollar to rupee is expected to stabilize in 2023 as the global US dollar weakens in the mid to long term. Due to the impact of monetary tightening, there was a banking crisis in advanced countries, but it has come down as the governments have responded quickly. The Indian rupee is expected to remain stable for a while as oil price stabilizes, India's inflation slows, and trade deficit decreases on expanding service exports. But inflation concerns are rising in the second half due to warnings of Super El Nino, and the dollar to rupee rate may rebound. The dollar to rupee rate is forecast to be at the level of 79.9 to 82.9. During the first half, the dollar to dong rate rose slightly and fell back in the first quarter and remained within a narrow range in the second quarter. But the dollar to dong rate is expected to get upward pressure in the short term due to slowing global demand, disappointing Chinese economy, and weak yuan. But the dollar-to-dong rate is expected to drop later on as China fine-tunes its economic policies and the global manufacturing sector rebounds. The dollar-to-dong rate is forecast to be at the level of 23,400 to 23,700. Although there are still many global uncertainties and downside risk in the second half of the year, the global monetary policy seems to be at a turning point, and the value of the US dollar will gradually decline in the long term. Also, we believe that the decline in semiconductor prices will stabilize, the trade deficit will narrow, and the supply-demand gap will be slightly tightened. But the economic recession and the financial anxiety that follow high interest rates will periodically suppress the decline in the Korean won exchange rate. In addition, the possibility of the tension in the Asian region due to the reshuffle of the supply chain and election events can be a discriminatory burden on the won. In conclusion, the dollar-to-won rate is expected to face some resistance in the second half of the year, but as the dollar weakens, the dollar-to-won rate is expected to move in the range of 1,220 to 1,320. Well, that'll be all for today. It's been my pleasure to provide you with Shinhan Bank's global economy and foreign exchange market outlook for the second half of 2023. I'm your host, HYUN, and should you have any questions, feel free to contact us at Solution and Trading Center. Thanks for watching.